right? So it should be recording now. So let's say what we got here: newspaper delivery, selling gum, candy, cutting grass. So let's use one of these examples, and we'll use that. Okay, so one of the students said that they cut grass. So let's pretend that you're 16 years old and you're cutting grass, right? And here's my lawnmower. Not a very great job, but wow, this is a bad drawing, isn't it? Okay, so you're cutting grass, right? And you go down and you ask your neighbor's house and you knock on the door and say, hey, is there any extra work I can do? And they said, yeah, why don't you cut our grass? And I'm like, and you're like, how much? And they said, I don't know, $10. So you go and mow their lawn and you do it and you get paid $10. And it takes you like probably 2 hours because you're kind of new at doing it, getting it all clean. So you make like $5 an hour, right? So what form of business are you running right now? I'm going to draw this again. Ooh, what did I do? Did something bad. There we go. A sole prop, right? So you're just operating as yourself, right? As a sole proprietor. So sole proprietor means that you are your business. There's no differentiation between you and your corporation or company at all. When your neighbor goes to give you that $10, they're probably going to give you cash, right? But if they write you a check, who are they going to write it out to? They're most likely going to write it out to you, your name, right? So if my name's Matthew, they're going to write it out to me. And when I take it to the bank to get cash, they're going to say, hey, Matthew, you have an account here? I say, yeah, do you have your ID? And then they'll give me that cash because my ID will match what's written out on the check, right? So setting up your business is really easy. And in San Diego, I don't have the actual days, but I think if you're under a week and you're doing business, that you don't have to file any permits at all. So if you're just running a business for the day, one day, that they're not looking to actively have you come down and set up a business license or anything. So technically you set up as a sole proprietor, you don't have to do any rules and regulations, and here you are collecting cash, $10. Almost everyone has done this, right? So most of us are entrepreneurs in some way or other, but what are the consequences of having a sole proprietorship if you're running your business, right? So what happens if you're mowing your neighbor's lawn and you run over a sprinkler and it knocks it loose and it floods their yard, and you have to go back and fix it, right? So it might not be that bad. It might be a few $100, but your neighbor's going to come over, and if they're not a nice neighbor, they're probably going to say, hey man, you broke the sprinkler, you were in charge of that, and as Ron says here, you have unlimited liability. So you're going to have to fix that, right? So, for a teenager, you just made $10 and now you're spending $100, $200 to fix the problem. You have all the liability in that case, right? So when you operate as a sole proprietor, you are the same in your business and you have all the same liability, okay? What is different is if you set up a company, right? And you call it, what do you want to call it? Did you have a name for your business? Let's call it Motown. Oh, I like that better, right? So let's say you set up a business, Ron, and it's called Motown, and you don't do any paperwork or anything at all. You just go to your neighbor and say, hey, I just started a business. It's called Motown. And you do the work for $10 and your neighbor writes a check out to you and then you take it to the bank. Are you going to be able to cash it if it says Motown as the person it's made out to? And Yes, typically no. The bank is not going to cash it and give you that money because they don't know who Motown is. So there's a couple ways to set this up. If it's you, right, and you want to call yourself Motown, there's two ways to set this up. One is you could form a corporation, right, and have that corporation called Motown, where you would be the owner of that. Or you could have your, Matthew here, and you're fill out a doing business as Motown. And you go down to the city and you file some paperwork and you let them know that you have a business called Motown. Okay? So we'll get more into the DBA in a little bit, but I want to talk about this definition of corporation or incorporation and what that means. So when we create a corporation, what you're basically doing is you're going from you as a sole proprietor and you're creating another entity. Think about like have another person, right, called Motown. And Motown it's not a living, breathing entity like you are, but it is an entity that mows lawns, right? So when the person is hiring an entity to mow the lawn, are they hiring you, Matthew, or are they hiring the corporation? They're hiring the corporation, right? So if the corporation has the contract with the customer, and whoever is the employee, whether it's you or somebody else, breaks that sprinkler, who is liable? Who has to pay that customer back? It's the corporation, right? And you guys all got this. This makes pretty much common sense. So what you're doing when you form a corporation is you're creating a barrier between you and the corporation. So one of the interesting parts is when you form the corporation, how much liability do you have? Let's say that you took, you got $1,000 from your aunt who said, I want you to start a lawn care business. And you took $1,000 and put it into the business, right? So if you put that $1,000 into the business and let's say you broke a main sewer line for some reason, you were digging and it broke and it created $10,000 worth of business, but you had a corporation, if the customer sues Motown Incorporated, right, you would just say, hey, I'm sorry, I only have $1,000 in the company. You can decide if you want to file bankruptcy for the corporation, and that's all you would owe that customer. Only the money that you put into it, you're held for liability. But let's say if you had $10,000 in your bank account and you put $1,000 into the corporation, you don't lose your other $9,000 that's in your personal savings. You would only lose the $1,000 that's in your corporation. But as if you had operated as a sole proprietor, if you never formed a corporation, and they sued you, the person, because as a sole proprietor, you operate as you, then all the assets that you have personally are up for somebody suing you, okay? So when we start out and we're, teenagers, and we don't have much money, it's not that big a deal to operate as sole proprietor because, you don't have that much to lose. But the more assets you gain, like when you buy a house and you pay that house down and you have build up some money, not necessarily your retirement funds, but, just your savings and all that stuff, that could be, if you're ever in a lawsuit, you could lose all that. So it's usually something that you form a corporation after a period of time. It doesn't have to be right away. So like I said, I have an LLC for my game company. For our promotional printing company, we have a sole proprietorship. Now, the reason I have a sole proprietorship, I shouldn't say we, the reason my wife has a sole proprietorship is that it costs money to keep a corporation up and running, or an LLC up and running every year. There's quite a bit of expense that we'll go over. And the reality of someone getting really injured or sued with a promotional products company is just not that high. So so that's one thing that I look at is like kind of like a risk reward type situation with our business. But as I get older and more of my assets are becoming valuable, and I've got a house that I'm paying down and stuff like that, I'm considering that I should put all my companies into a corporation to limit my liability. Kim said, is your 401k or Roth at risk if you're sole proprietor? Typically, no. From my understanding, I'm not an attorney, so I've never been sued to the point where I've had to worry about that. But from my understanding, that no, your retirement should be not subject to lawsuit. That's why, what's his name? Who's the guy that, why am I blanking on his name? The guy with the white Bronco. O.J. Simpson, right? So he wasn't found guilty in court for the murder conviction, but he was sued in civil court saying that his wife's family was suing for money, and so he lost that court case. So he lost millions and millions of dollars, basically wiped him out. But since he was an NFL player, he got to keep his pension, so they couldn't touch that. So there are some things that are protected from lawsuits. So and Anna, you asked about liability insurance. Liability insurance is good, so we'll talk about that in another module. But yeah, if you have liability insurance, if you get sued, depending on the type of lawsuit, the insurance could cover a lawsuit. So for my game company, I have insurance because a lot of games are going out and random people are playing them, and who knows what could happen. So I do have liability insurance for that. And also some of my retailers require me to have $1 or $2 million of liability insurance. So I have $2 million of liability insurance just so I can do business with some of these. So some of my main customers require me to have it. So good questions. So let's go back to this little thing. All right, so sole proprietor or corporation. There's different types of corporations, S Corp, C Corp. LLC is technically not a corporation. LLC stands for Limited Liability Company. So we'll talk about that and what's that type of protection for you. So let's go back to the slides. Okay. Okay. So what's the percentage of businesses that are set up? So of all businesses set up, about 3/4 of them, about 73%, are sole proprietorships. That means they've never set up a formal corporation. 8% are partnerships, and the rest are corporations. So most businesses out there are sole proprietorships. It's the easiest one to set up because as soon as you start doing business, boom, you got a sole proprietor. Okay, so let's go over each of these. And feel free to ask me any questions along the way because we can talk about it. How do you report taxes? So that's one of the another big questions besides the liability issues. How are you taxed as a business? If you do business and you're collecting $10 at a time for lawn, technically you should be reporting this on your taxes. Chances are if you were a kid and you were 16 years old or 15 and making $10 here, $20 there, you probably just didn't do it. But technically, any income that you make as a sole proprietor, you would file a Schedule C on your 1040 tax form, and you would list that, hey, I'm a sole proprietor, and this is the money I brought in. When you do your taxes, you'll also be able to say what your expenses are. So if you bought a lawnmower, if you bought gas for the lawnmower, if you did any driving to get to your customers' houses, any of those things, those could be subtracted from the money that you brought in as expenses. And at the end of the 1040, you would show your profit, and then you would owe the government taxes on that, right? The pros and cons of sole proprietorship. Pros are, it's very easy to set up a sole prop. You just start making money, right? And in some cases, you don't even have to file a business permit or licensing for it. And taxation is pretty simple. When you do your taxes, you just pull out all the money that you made and you add up all your expenses and you report those on your Schedule C. The cons that we talked about already, it's unlimited liability. So everything that you have that's yours could get taken from you, aside from the retirement situation that we talked about. But another con that most people don't think about is the business ends with the individual, and you can't sell or pass on your business very easily. So let's say that you have this, if you have this lawn care business and you do it for a while and then you turn, like, you're still going to college and you're 21, you get another job and you don't want to do that lawn care business. If you have 25, 50 clients, you might want to sell it to your younger brother or sister or your neighbor or something like that. So how do you transfer ownership if you have a sole proprietorship? You can't sell yourself. So the way you would do that is you probably come up to some situation where, like, hey, for $1,000 or whatever you want to say, I'll give you all my clients and you take over. So there's ways around selling your sole proprietorship to someone else, but the tax implications of you making that sale, technically it's not a sale, you're just getting $1,000, and that's listed as income, and income is typically taxed at around 30%. I'm not an accountant person, so if anybody has more experience on this than me, let me know. But let's just say it's 30%, whereas if you sold a company, you might be getting that money as capital gains, and that capital gains might be 15 or 20%. So, $1,000, that percent doesn't make that much difference. But if you create a company that's worth $100,000 or $200,000 and you sell that, that's a significant amount that you'll lose in taxes. So one of the cons with a sole proprietorship is you technically can't sell yourself. So it makes transferring the business very difficult. All right. Any questions so far? Okay. Not yet. All right. Well, this part's pretty easy. Most of you, especially, I know a few of you have started your business already. We're kind of talking about what you already know. But the more difficult part is the minor differences between the corporations and the issues with taxation. So how do you set up a sole prop? One, be a person, start making money. Super simple. Seriously, you choose a business name. If you don't choose any name at all, then your name is your business. So my name's Matthew Rivaldi. My business is Matthew Rivaldi, and that's who you make the check out to. If you go file a business permit or license, you would make it out to Matthew Rivaldi. That's what your business is called. And if you decided to call it Motown, if you call it Motown, then you would file a fictitious business name statement or DBA, doing business as, and you would let the city know that, hey, I'm doing this business as another entity just than my name. There's two main reasons why you would want to do a fictitious business name or doing business as. One is the city wants to track businesses. So if you've got a business in San Diego and San Diego's getting all these complaints saying, hey, this company called I keep forgetting the name, Motown. If they're getting all these complaints about this business, Motown, breaking everybody's sprinklers, they're going to want to track who that person is. So that's one reason why the city wants it. Another reason that you would really want it is if somebody writes you a check to Motown and you take it to the bank, they won't let you cash it, right? So if you show them your completed fictitious business name statement, the bank will add that name to your account so that anytime you bring that check in, they'll be able to cash it for you. So those are the two main reasons you would need to do it. All right. Another thing that's important for sole proprietorship is obtaining an employer identification number, or EIN. You know, if you do business with your neighbor and it's $10 to mow their lawn, they're not going to ask you for your social security number. But if you're doing, you know, $1,000+ bucks in business with a business, they will likely ask you for a W-9, which is information on who you are as an entity. And what you use typically as a sole proprietorship for your tax ID number is your social security number. And most of us don't want a social security number out in the public. So you can ask and receive an employee identification number. I believe the federal government will give you that for free. It's just an application you got to apply for. And they just give you a different business EIN number. And that way, when businesses ask for your information on your business entity, you give them that and your EIN number. And that way you don't have to share your social security number. So that's, I would highly suggest you do that. You don't have to do it. You can use your social security number, but you know, you don't want that just out in the public. Evans asked, how large should your company be before you stop using your name? That's really up to you. You know, some people have a domain name, and you know, you tell people to go to your website, but is that the same as a business name? It's really up to you how you want it set up. Personally, I think it's important to you, depending on the branding of what you want to do. So I'm of the opinion you should create something that if you get tired of doing it, you could easily sell it off. If somebody is thinking of creating a name for themselves, I mean, what happens when you want to sell it? I mean, what happens with Ivanka Trump when she has her shoes and she's no longer running her business anymore? Is that name this one that she wants to sell to somebody else to run? I don't know. I would be concerned using my name as your business name, because what happens when you want to transfer it or sell it? Then somebody's got your name, but you still have your name, which is kind of weird. All right. So that's one thing you want to think about. In fact, they still have, what is that place? Henry's Marketplace? Sprouts, right? So Sprouts used to be Henry's, and before that it used to be called Boney's, because the guy's name was Henry Boney when he started. So this is what, 20 years ago or something? So he started and it was called Boney's, but he had like all these kids and stuff like that, and he was getting older and he wanted to transfer it to the kids. And when he did that, he decided to change it to his first name, Henry's. That way the Boney's name wouldn't be associated with the business anymore, even though they weren't owning it anymore. And then they eventually changed it to Sprout. So it's kind of expensive changing your name for your business. So you want to think about that when you set it up. We'll talk more about that later in another module. Good questions. And then, so how can someone sue you? That's a good point. I think they'll be able to figure out who you are if they really want to sue you. Lawyers are really good at figuring out who has the money when they want to sue you. It's like it's their job or something. All right, let's move on. Past sole proprietorships. Let's go to partnerships. And what is a partnership? A partnership, just in a loose definition, means anytime you partner or you form a team with somebody else. So you can have a partnership between two people, two sole proprietorships, but you can also have a partnership between two companies. So in the loose term, partnership just means any deal that you have. So I just want to be clear what that means. What I'm talking about in this class, what does partnership mean as far as a legal organization? It's the contract that outlines the nature of the business, the roles of partners, and how profits and costs will be distributed. So typically I'm talking about two sole proprietors, two individuals that team up and form a partnership. Now I said my wife and I have a business that we both work on, but my wife is the sole proprietor. So technically I don't own that business at all. It's all hers. You can be a sole proprietor and hire somebody else as an employee. So I guess I'm an employee. I'm an unpaid employee because I don't get paid. You're like, what kind of business is this? So, but yeah, we have a joint account, and so technically it's set up as a sole proprietor, and if we get paid, we just take that money and put it into our account. So we usually use that money that we make off there to go on a vacation or trips or stuff like that. It's a little side business that we have. So, I'm not an employee. I'm not a partner. Technically, it's a sole proprietor. You want to just be very clear. Like if you say partnership and you're writing a business plan, then that means something to a bank or an investor. So oftentimes when I'm looking at students that have written a business plan, I'll see what one of the questions or one of the sections is, what form of entity are you? And it says sole proprietorship, and then it says who are the owners, and it lists all the owners. And it might have 3 or 4 owners, and that just doesn't make sense. So a sole proprietorship is just one owner. So technically. But if you have multiple people, then it's a partnership. So let's talk about that, because there are different types of partnerships, and this is where it's very dangerous to form a partnership, because it's really easy to set up a partnership. You just, you could just shake someone's hand and say, hey, you and I are going to agree to go around the neighborhood and mow lawns, and that will, you do more of the marketing and I'll do more of the lawn mowing. So you get all the contracts. So you split up the divisions, right? Which is fine. But what happens when there's issues? What happens when someone wants to leave, right? So let's talk about that for a little bit, because it's very easy to get into a partnership. So I say usually a contract is signed outlining the nature of the business role of partners, how profits and costs will be distributed, but it's very common for people just to say, hey, I want to start a business. Oh, I want to start a business. Oh, we should do it together. All right, boom, you have a partnership. It's just like we talked about earlier, you might not have filled out the business license, you might not have filed any paperwork, but you have a partnership, which could get you into some trouble. There's 2 main types of partnerships. There's a general partnership and a limited partnership. General partnerships are all owners assume liability, and this can be really dangerous, like I said. So in this situation with the lawnmower, the lawn care business, let's say you start that business and then you and your buddy are doing it, and your buddy is the one that breaks the sewer pipe, right, which floods the house, which causes all this damage that they have to fix, and it ends up costing $10,000. If they decide to sue your buddy and they find out that you're a partnership, then both of you are on the lawsuit and you're both liable for $5,000, right? So all owners assume the same liability. So it's a shared liability, which is good, because you don't, if you're the one that broke it, then, you get to split it with your buddy. But then, how are you going to split that up?
Or your buddy's broke, you have actual.
Yeah, and like I said, and Luis asked here, he's like, what if you're broke? What if your buddy's broke and you have the $10,000 because you're good at saving? Yeah, like I said before, lawyers are good at finding where the money is. They're going to get their money. They're good at doing that. So yeah, that's not good. Also, all owners share profits. What happens if your buddy's kind of a slacker and he was supposed to do all the marketing, but you're doing such a good job at mowing lawns that, your neighbor is so happy that you get the next job and the next neighbor, and they just tell our friends, and you're like, oh, you have to use that. And all of a sudden you're doing all the marketing and all the work. And then your neighbor's like, oh, I'm a partner. Yeah, I've been doing it. Right. And they're asking for a split on all the profits. You're like, what? So that's another thing you have to look at is what is the agreement you walk into it and how do you get out of it? So as a partnership, all owners share profits. All right. Another different type of partnership is called a limited partnership. And this is where, especially if you're asking for money and you're not familiar with setting up partnerships. So someone might ask you to do a limited partnership. So I want to explain what that is. It's usually where one of the partners is limited to the amount invested. And that person that invests the money typically won't have management decisions. So it requires a partnership agreement, and you can actually file some forms with the state to form a limited partnership. So let me give you a better example than the lawn one. So let's say that you had the lawn care business and you were going to school and you were getting your contracting license, and then you started, doing carpentry work. And then after a number of years, you become a full-blown contractor, right? So you're kind of new at contracting, but you're really good. You got lots of good referrals. And you're working at this house and you find out the house next door is kind of beat up and broken. And you find out you can get it at a really good price, and you think you can renovate it and flip it. Okay. But you don't have the money to buy the down payment and do the renovations, but your rich aunt does. And so let's say you go to your rich aunt and you say, I need $200,000. I need $100,000 to put the down payment in to the house, and I need $100,000 to fix it up. And if we do that, I think I can make easily, $200,000 profit. And so I'll split that with you. So your aunt's going like, that's awesome. I put $200,000 in, I can get $100,000 back. Like, that's a great deal. Now, so let's say that you're new and you didn't realize that the house was such a good deal because it was on a canyon, right? And you start working and you didn't realize that you took out part of the basement and it starts sliding down the hill. So you don't make any of that $200,000. You actually lost all the profit that you thought, plus you lost all your aunt's money, right? So what happens? So if you form just a regular partnership, then you're both liable for an equal amount. All right. So if your aunt is smart, she'll say like, yeah, I'll give you that money, but I want a limited partnership, and you'll write out a contract and you'll file a form that you have a limited partnership. She'll put the $200,000 in. And if in the event that happens, the same situation happens, she's only liable for the $200,000 she put in. As long as, those factors are what you say they are. She put the money in, you had a contract, she doesn't have management experience or control, she's not telling you what to do, but you're the one that screwed up. She's liable for that $200,000 she put in, you're liable for more money than that. So if it slid down the hill and landed into another house and caused damage for that, right? So not only you didn't make any money on the house flip, but you're having to pay for the other house, then she's only liable for that amount. So so that's an option you may want to look at if you're doing something, and especially with investors, if you're doing just a deal, they're probably going to ask for that. So that's something you want to be aware of. Now you may be wondering at this point, this all sounds complicated, right? Contracts, and we haven't even started talking about corporations or anything like that. At some point, I'm not an expert. I'm not a lawyer. I'm not an accountant. I'm an instructor. I have experience running businesses before. But but I can't tell you all the contracts to do or how to set them up. So I can't give you legal advice. And so the only one that could give you legal advice and charge for it is a lawyer. And so you're probably thinking to yourself, that costs a lot of money to hire a lawyer, right? But you think about it, when you get into deals and situations where you're talking about hundreds of thousands of bucks and possibly losing it, possibly getting sued, or possibly making a business that's worth a few $100,000, you're probably going to think to yourself at the end of it, you're like, man, I should have spent that $1,000 or $2,000 consulting with a lawyer so I could have set this up the right way. So I think someone asked earlier, like, when's the right time to set up the corporation? When's the right time to set up the business? Well, that's part of the planning process that we'll get through. And that's why we have the first 6 weeks to talk about kind of the knowledge of what it's set up. So you can kind of estimate, like, maybe at this point I'll talk to a lawyer. Maybe at this point I'll incorporate if I hit these milestones. That way you're using your resources wisely. You have a limited amount of money, and when you decide to set up your business and consult with an attorney should be along a path. So I wanted to give you a little background on the steps you'll likely make before you start planning or getting yourself into a situation like forming a partnership when you're not yet ready. Okay. All right, any questions? We're doing good? Carling asked, she said, does the business name need to be unique, and how do you check it? So that's something we'll go in our I believe it's module 6. We talk about intellectual property. So it's my favorite subject when we talk about creating intellectual property. Intellectual property means something that you can't feel or touch, but it's worth something. So your brand name, that's intellectual property. It's basically creating value out of nothing. So how do you check and make sure that you don't have the name? Ron says that Motown already exists. Yeah, I mean, good names are probably going to already be taken. So I'll talk more about it in that module. The one thing I can say right now, if you're rushing to go out and get a business license right now, a business license doesn't mean that if you go down there and you type in the computer and it says Motown is available in San Diego, that doesn't mean that doesn't mean that you're able to use it, because there's issues with trademarks. And when you're doing a business name search, it's not the same. So we'll spend a whole module talking about that. And I was informed that this is, I guess that would make more sense to be Motown, right? Because I think Motown's the singing, right? So let's change that to Mo.
He sings while he's putting the
Motown. All right. Oh, we have so much fun in these classes. All right. Come on. There we go. So pros and cons of forming a partnership. One, they're inexpensive, kind of like sole proprietorships. They're easy to start. You share the responsibilities and expenses. That is kind of nice that if you're starting a business, you both pitch in, you can start a business. So you're kind of sharing the startup costs. Also, if one of you want to take a break or a weekend off, or you're busy with finals or something, you can do that. So partnerships are good. The cons are, again, it's really hard to sell a partnership. And also, if someone wants to leave the partnership, then the partnership ends, right? As soon as someone wants to leave it, it ends with a single partner leaving. You have the liability for both partners' actions, and you share the profits. Okay, so let's talk about corporations. So moving away from sole proprietors, moving away from partnerships, let's talk about corporations. And I said before, corporations are their own entity, and there's a factor called going concern that's really important, and it's an accounting term. Accounting basic principle that means the company will continue on into the foreseeable future, often past the ownership or lifetime of the founders. Going concern. So if you think about, some of the biggest companies out there, let's say, for example, Ford Motor Company. I believe there's a guy named Ford still working there, right? The son of the son of the son. So it's gone through several generations, but the company is called Ford. If the last Ford is not working there anymore, someone else will run it. It's not a big deal. But the name goes on. And as you create your corporation, it's like forming a new entity. And this entity becomes a life of its own. Okay? So if you go there and you put that $1,000 into the bank account, your bank account now has a relationship with Motown Incorporated. And if you sell the corporation to another individual, the checking account at Motown will stay the same, right? You're just selling that. So the bank has this relationship with the business, the corporation, and just like you have started to build up credit for you personally, right? You went and got a checking account at some point, and then you probably went and got a debit card. And then after a while, you might have applied for a credit card, and they slowly increase your limits so you can do more and more. So the longer you're there with your bank, the better you are at paying that credit card back, the more credit you're going to get. And just like you as an individual, the same thing happens with your business. So the longer it exists, the more credit and the ability to pay it back, you build up that. So it's got two factors. One is you form relationships of your corporation to outside entities like banks or customers or vendors or whoever. You build up credit. And it's also easy to sell it off to someone else and keep those relationships alive, right? So that's the concept of going concern. So it's much easier as a corporation to do that than as a sole proprietor. You can't really transfer your credit rating to someone else, but you can have a corporation. Okay. Let's go back to the slides. So types of corporations that we're going to talk about: C Corp, S Corps, and Benefit Corps. We'll talk about those. Hold on one second. I've talked a lot about this already. Advantages of corporations. Some of the advantages are management can run your company. So you can start your business and then you hire a manager and then you can start another business, right? And that way you can go and do different things. Your manager can be there running it. You can raise large amounts of capital. So if you put that $1,000 in to start your business and you slowly are making profits and you're starting to buy more lawnmowers and trucks and you're doing bigger deals, you might be able to take a loan out from a bank through the corporation to buy those things, okay? You've got the liability protection. The legal entity is separate from you. It's permanent. It's got the going concerned issue. And you're protected versus you're protected with the amount that you originally invested in the corporation. So some of the disadvantages is a corporation is impersonal. So when you first start it, when you're dealing with new banks and you're dealing with new vendors, they don't know this relationship yet. So it is an impersonal relationship. They know that if you don't have a lot invested in it, that you could just always fold the company and not pay them back. So just like people, you need to start forming relationships and building that up so they trust you and they'll give you more and more credit. Owners have limited interest in the firm's activities. Let's see. There is some startup fees, which we'll go over. There are some reports and procedural issues that you have to follow. You're limited by your operating agreement or your charter. So especially if you have partners, you'll form something called a operating agreement or charter that specifies how you get paid, who can borrow money for the business, if somebody's going to get paid a salary, those are usually in the operating agreement. And different states have different rules. So states usually are the ones that organize your business. So if you're forming an LLC, they will vary quite a bit from state to state on what they do, since those are not federally recognized, which I'll get to in a little bit. Okay, so this is one of the main issues with corporate taxations is pass-through versus double taxation. So we could either go through this right now, or if people want to take a break, we'll take a 15-minute break and come back to it, because this is a little bit meaty. Do people want to take 15 minutes? Yeah, let's take 15 minutes. Let's come back at 7:20, and I'm going to pause the video. I'll pause the video. Okay, so it should be recording now. So we're back. A couple things that I started to share on break, but I didn't want to share with you until we had talked about it. In Module 2, setting up the business, you'll notice we have some online content. It's just a ton of links about setting up your business, and it's stuff I've put together that's specific to San Diego, but also California. Let me mute everybody. All right. In the module, I have all these. Ron, you're funny. So some of the permitting that we're talking about, like a lot of the links are for setting up your business are in this module in the Blackboard. So this document right here, and I'll share this. It's in the email that I sent out to everybody, the link to one of the modules. But one of the cool, gosh darn it. So under setting up your business in San Diego, here's your business link to set up your business permit. But one of the neat websites, it's called calgold.ca, and I've already sent the link, but I'll send it again, just right here through the chat button. If you're wondering about what permits and licenses you need, you can select your city. So you can say that I'm from San Diego. And you can say what type of business you are. So if you're a restaurant, so this is from the California's Governor Office of Business. You can type your county, the type of business, and so we set restaurant in San Diego. It will list all the city, county, regional, state, and federal permits and licenses you might ever need, above and beyond anything you would probably ever need. But these are all the places to do it. So the city of San Diego, where you get a building permit, where you get a building license, business license, and it includes the phone number, the location, and the website. Just note if you do this and you're looking up regulations that you're going to get everything, right? You're going to get proof of residency requirement. You're going to get EIN number that we talked about earlier, workers' comp. So it might not mean that you need to get all those permits and licenses. It'll just list all the ones that might be applicable to restaurants. So it's a good place to start. And this is something, as we're working on the final assignment for this class, I haven't released the full document yet, but I'll share with you the template that we're working on right now. So for our final assignment, I just shared the link with it. A lot of what we talked about last week, we talked about resources that you need to start your business. So it's just a document that you can work on while we're going through this class, okay? So the questions are designed to help you. One is describe your business opportunity. Second is the resources needed to start your plan. That's what we talked about last week, some of those skills that you might need, but also money, anything that you would need to start your business. Write these down. Make a list of the things that you need to do to start your business. We did your skills assessment. So question 4, you can write or type in the skills that you already have that you think you'll make yourself a successful business owner. So the questions that we're talking about tonight, what legal form of business, that would be the question 5 on the final assignment for the 6-week course. Question 6, well, what permits and licenses will you need? So that's a good one to go to CalGoal and just make a list of all the types of business permits and licenses you need. We're talking tonight about location, a little bit. Where will you run your business from? We'll talk about that a little bit more in one of the other modules when we talk about distribution. But if you're planning on running your business from your house or setting up a website or something, then you would list it here. So some of the other questions we'll get to later in the other modules, but it's good for you to know that that's what we're working on for the final assignment. And I'm going to make a note to make that up on Blackboard for you too. But I'm giving you a little preview of the final assignment. So let me write a note here. Okay, I will try to get that up on Blackboard tonight, if not tomorrow. That way you can access the final assignment. So you can start working on it. And again, these assignments are more for you than they are for me. So every week I want you to turn them in and on time. But that's mainly to keep you on track. So you do have to turn them in if you want to pass this class and get an actual certificate saying you completed it. But what I found is most people are entrepreneurs. They're taking this class because they want to start a business. So I try to make this assignments mainly for you. So I won't tell you if you're right or wrong on doing them, because I've seen lots of business ideas I never thought would be successful. They're really successful. So my job isn't to tell you if it's right or wrong. My job is to challenge you to make it the best it can be. So I'll offer you advice if I think it's applicable, but most times I'll encourage you to be your best person. So, all right, so let's go to the screen. Let's keep talking about forming a corporation. So remember I said at the beginning of this course, a lot of this is like a ton of knowledge that I'm dropping on you. And then as we move into the second part of the planning, we use that knowledge to put together the plan. So keep that in mind. as we move into the second half of this program, the second 6 weeks, will you be using this to create your business planning? Okay. Shoot. Wait. Okay, we're talking about pass-through and double taxation. That's where we are. Pass-through versus double taxation. What does this even mean? So let's go back to the drawing that we have here. Okay. I saw someone add a chat question. Kim, are you the only one having an audio problem, or is? It is run over the internet, so it might just come and go, but just let me know if it's bad. So, and it will be recorded, so I'll put it up if we're missing anything, but it might be your end that you're having a problem. Again, if you have a problem hearing, you can also call in and just get audio from the phone, which is the phone number is there you go. So that's the phone number. You can call in. You're going to have long distance or regular data rates apply to that phone number, but you might be able to hear better on that than an audio connection if your Wi-Fi is not up. Okay. So we're able to see it. Okay, good. So let's talk about pass-through versus double taxation. So I already told you how the individual pays taxes. They file their Form C on their, what is it? 10W40, right? Yeah, at their end of the year, it's their Schedule C. The corporation will file different forms depending on what type of corporation they set up as. Okay, but at the end of the business year, who's going to be asking for money? Right, the IRS is going to be asking for money. And so this is where it becomes an issue of how you're going to set up your business. That's really important. If you're setting up your business for yourself, then you file that tax return on your regular tax return, and it's just fine. If you're Motown and you make whatever you make, then there's two different ways it will be sent to the IRS. So the first way is pass-through. So let's say that you've grown up your business and you've got some employees now that are all helping you do this, right? You've got a good business. Let's say you have 10 employees and you're able to make, and now you're doing lots of businesses, you're doing really good. Let's say you bring in 500,000 in business. You've got a great business going on. And with all your employees that you pay, you have expenses of 400,000. Okay? Including yourself. You're paying yourself because you're one of the employees. So the little parentheses mean subtract. So at the end of the year, you have $100,000 in profit. There you go. So there's two ways these are going to be reported. One is if it's passed through. Get that little thing out there. One, if it's passed through, you'll get a form, typically from your accountant. It will go to you, and if you have a LLC, it's a K-1 form. If you have a corporation, it might be called something different. But you'll get this form that will basically say, hey, Matt, you made $100,000 on your business, and in your taxes at the end of the year, you'll send that over to the IRS, and the IRS will say, hey, you owe $30,000, right? So for your taxes. And that's called pass through. The form comes to you, you write that on your taxes, and it's passed through the business, and the IRS only sees the form really from you. Okay, so the corporation is not paying any taxes or filing any of your statement that's paying the taxes. You're paying them. Now, what's important to note is that what's coming to you, the form, is just a piece of paper. If you decide to pay yourself $100,000, you can also draw that $100,000 out of your bank account, along with that piece of paper that says your company made a profit of $10,000 or $100,000, and you can pocket that. What happens, though, is that with this money that you make for your business, you may want to grow your business. You may want to buy another truck. You may want to keep it in there so you can pay your employees. You need to have a little cash in your bank account. So you typically don't take all the profits that you make out at the end of the year and pay yourself. So if you're paying yourself, let's say if you wanted to keep that $100,000 in there because you need to pay employees every month, right? And your vendors aren't, your customers aren't paying you on time, so you need to keep a little cash in there. You might only take $50,000 out, but you still owe $30,000. You might not take anything out, but you still owe $30,000. So it's important to note when with pass through, you have to pay the taxes on the profit, whether you get the money or not. And this became a big issue with me in my game business because at the end of the year, I would show a big profit, but sometimes my customers wouldn't pay me on time, or sometimes I would have to buy new inventory. So all this $100,000 would go back to doing the inventory, and I'd still have to pay that money. So that's pass through. Most of us, when we start a small business, we choose to do pass through. So let me show you the other scenario. So let me make this a little bigger. Let's erase this here. So the other scenario is called double taxation. And that's where it's $100,000 and the corporation sends it directly to the IRS and says, hey, we made $100,000, and the IRS says, okay, it's $30,000, right? So you delete $30,000 because you pay it, and the company has now $70,000 in their bank account, right? So it's paid. You don't need to do anything else to pay any more taxes to the IRS unless you decide to take some of that money and you want to pay yourself that $50,000. So if you take that $50,000 and pay yourself so you have $20,000 left over in your business, you basically earned an income of $50,000 that you would also have to send to the IRS that you made an extra $50,000, and you would pay tax on that as well, income tax, right? And I'm making up these numbers, $30,000. I don't know if that's what the actual numbers are. It could be, yeah, depending. Yeah. I know, never mind, huh? So the objective is, try to keep your profit as low as possible. Keep investing in your company, right? Profit is different than cash. So that's an important thing to note. Like, if you have $100,000 and that's this profit, and you might not have that cash. You might buy inventory on January 15th, but your calendar year ended on December 31st. That just means that, profit is very different than cash. That's why it's important to look at the accounting class. It gets you really messed up. Anyway, so this is double taxation, and you're probably wondering why anyone would want to set up a double taxation. And it's kind of it's probably not the right term for you to initially think, because you think you're paying double the amount of tax, and that's not necessarily true. So what is a scenario where you would want to be paying or want to set up your business as double taxation? Because you're probably going like, that doesn't make any sense at all. I don't know why it keeps doing that. All right, so let's go back here. So let's change the scenario. Let's say that while you're working on Motown, you come up with this crazy idea to start this little company called, right, Windows. Did I draw it right? So on the side, you were developing this program, and you created this company called Windows, and your name's Bill Gates, right? And so you sell this software to millions and millions of customers around the world. So this number is not $500,000 that you make, but maybe it's 500. I don't know. Let's come up with a different number. All right. Let's erase this too. So instead of $500,000, let's say that your business is huge, okay? And you're making $500 million, and your expenses were $400 million, and your profits at the end of the year were $100 million, right? And you sent that to the IRS, and they said, okay, you owe $30 million in taxes, right? You're left with $70 million left over in the business. So in this situation, it's nice to have the corporation pay for all the taxes and assume all that. If you were making this amount of money and you got $100 million profit year, if it was passed through, that $100,000 would have gone to you, and you would have been responsible for paying that $30 million or whatever it was to the government. And that's a huge problem for you to have, okay? You don't want all that personal liability, that money coming into you, because what if you get sued personally, right? Sometimes it's better to keep a lot of that money and assets in the business. So double taxation is good for larger businesses because it gives you a lot more advantage. So there is some advantage to having a double taxation. So that's one of the things when you're setting up your business, you really want to pay attention to what are the advantages and tax implications of what you want to do with your business. So in a nutshell, that's what pass-through and double taxation mean. Is there a different timeline for businesses versus individuals? Yes, you can set as a corporation or as a company, you can set up a different tax year than the regular January to December personal tax year. So for your business, you can say, I want my tax year to start on March 1st and end on end of February. So it doesn't have to be the same calendar year. A lot of people do that because it allows you some time flexibility between your personal finances and your business one. So that's not uncommon to do. Good question. Any other questions before we move on? And I'll share with you some of the differences in C Corp versus S Corp. But all right, I think you're following along. This is a lot of information in tonight's lecture. So oops, that's not what I wanted to do. Yeah, the fiscal year, that's what it's called. Okay, C Corporation. We're gonna talk about C Corp, S Corp, LLCs for benefits. So C Corp, what's a C Corp? There's something I want to, it's one of these documents. No, that's not it. Where is it? Ah. Not this one, sorry. I sent it in your email, but I'll give it to you again. It's a little handout. Okay. So it's a little cheat sheet for you to look at the forms of business organization. It's got C Corp, S Corp, LLCs, partnerships, sole proprietors, and even nonprofits. And then it breaks down who the owners are, what are the membership requirements, the business purpose, who pays the income taxes. Okay. Double taxation. I'll even add that right there. So we're looking at C Corp right now, okay? So who are the owners? One or more shareholders, okay? One of the differences between a C Corp and an S Corp is S Corps are limited to 100 shareholders. So you can't have over 100. C Corps that we're talking about right now can have over 100 shareholders, okay? So C Corps are sometimes just called corporations. The C stands for corporation. To establish a C Corp, you figure out what you're going to call your business name, register it with your state, file documents, and they vary state by state, what documents you need to file. You issue stocks to your shareholders. The pros and cons of corporations: they are a separate legal entity. You get the limited liability. You have corporate tax treatment, so it's the double taxation situation, right? So the corporation pays the taxes. You can have over 100 investors or shareholders in your business, right? The cons are it's costly and time-consuming to start and maintain. There's the double taxation issue, extensive paperwork. Most people file C corporations when they're having a high growth, big business where they want to eventually have initial public offering and share lots of shares to the stockholders, right? This is where most people form a C corporation, okay? You can have over 100 owners. The company files the taxes. An S corporation is a corporation with the S signature. I believe that stands for sub corporation. That's where the S comes from, I believe, if I'm remembering. It is a federally recognized corporation where taxes are passed through to shareholders. So I'm going to make that note before I forget. Oops, that's not what I wanted to do. Where did my document go? There it is. Pass through. Okay. It's a federally recognized corporation. All right. Any owner that works for the corporation must be paid reasonable compensation. So this is one of the things you have to consider on some of the corporations is that if you're the owner of a business and you're doing work for that business, you don't just own it, but you're managing it or you're doing the job. So if we go back to this image of you and you're Matt doing Motown and you're working for the business, whether you're mowing lawns or managing the business or something, you have to pay yourself a salary. So in this, you know, of your expenses for your business, the 400 million or 400,000 or whatever business we're playing around with, that would become part of this expenses. Would be you would be getting a paycheck from your business. Okay. All right. And to back up, you're probably asking yourself, why would I want to get a paycheck from my corporation anyway? One of the neat parts about an S Corp versus an LLC, where you can't really, I don't believe you can pay yourself as an employee from an LLC, from my understanding. One of the neat parts about an S Corp is if you're trying to buy a house or something, you become an employee of your own company, and that way you're showing income. So if you go to the bank and you're trying to buy a house for yourself personally, you're like, you have income stubs to show that you're getting paid. So it's a nice way to build up your own personal credit. Whereas at some businesses, you don't pay yourself as an employee. So there are some advantages to that. To establish, you file as a regular corporation in the state where you can be headquartered. And then all shareholders must vote to become an S Corp. So it's really easy if you're the only owner. You just like, hey, do I agree? Yes. All right, great. And then you file for the S Corp status, and then you're granted that. Okay. The pro is there's some tax advantages because you're the pass-through. And of course, the going concern, independent entity. The cons are, again, is some paperwork issues. There is shareholder compensation issues. So if somebody is owner of the company and they don't want to get paid and they're doing work, they should be getting paid through the company. Shareholders are limited to 100. So if you're looking to have lots of investors, this is not a good form. Other cons is you can't have an S Corp owned by another corporation. So the research I've done says S Corps can't be owned by other ones. So if you're looking to have another company buy you and own it and keep that business running, then it's not a good thing to do. So if you may ask yourself, what does that mean? If you own several businesses, maybe you own one all by yourself, and then you form a partnership with somebody else and form a corporation, right? You might want to have that other corporation that's with your buddy owned by your main corporation. Instead of you owning two different ones, your company owns the second one. So how you set that second one up could influence what you want to do. I found some research that says S Corps have to be owned by U.S. citizens. So from my understanding, that's true in all states. I don't know if California is different. So that might be something you look into, and if that's a very strict policy or what's the process with that. So that's one thing I did note on the IRS. It did say that, so I'm putting it down here. Okay, let's move on to nonprofits. So nonprofits are a corporation, just like a regular corporation that we just talked about, a C Corp. Nonprofits are a corporation that asks the federal government the ability to retain profits to serve a public benefit. So if we're looking at our document right here, what you're seeing is if you're this business and you have profits of $100 million and you report it to the IRS, they're going to say, okay, you owe me that $30,000, right? Or $30 million. If you're a nonprofit, you're asking the government, hey, can we keep all this money? Because we're doing some type of public good for it. And they'll say, okay, you don't have to pay us profit. The only thing is you can't pass that money on to you if you're a nonprofit. Okay? The money has to stay in the nonprofit. And so it's being returned. So there's not a big incentive for you to amass a lot of cash or a lot of profits that you're going to distribute to owners with the nonprofit. So churches are nonprofits, foundations are usually nonprofits, schools can be nonprofits. All right. They usually have a public good. And this is where I usually start getting some questions from people. Well, let's go a little bit further. I'll stop, take a little break here. So how do you create it, a nonprofit? First of all, you choose or appoint a board of directors. You choose a business name. A lot of this is similar to a corporation. The one thing that's really important is the board of directors, after you incorporate and after you file your federal and state tax exemptions and they get approved, your board of directors are going to run the nonprofit, and your board of directors can include you, right? But you're not you can't have a board of directors of just one. So you're going to become a minority director of your nonprofit. And so technically your other board of directors, if they don't like you, they could vote you out of the nonprofit. So according to your corporate bylaws that organize how your nonprofit is run and your board of directors meetings, it's something that I want to stress. If you're forming a nonprofit because you want to make money on it, you just don't want to pay taxes on, it's not a really good, healthy way of looking at why you're forming the nonprofit to begin with, because it's just, that's not what nonprofits are really designed for. So I have 2 kids, and they're both at elementary school. And sometimes they need a little extra money to have, resources for the teachers, or sometimes they need some art classes or instruction, or they might need new carpet in the faculty lounge or something like that. So I didn't form it, but some parents before me had formed a nonprofit. So if I want to donate, or if they want to have bake sales or fundraisers, we raise money through the nonprofit, and then that nonprofit provides those resources to the school. So we're not donating to the school, you donate to the foundation or the nonprofit, and they support that. Now that my kids are in the school, we work to support that nonprofit, the foundation. And when we're done, the new board of directors will take over and they'll serve their kids. So it's an ongoing thing where it kind of rotates through the parents, and it's run that way. That's a healthier way to look at a nonprofit. Is to look at it, if I'm setting a nonprofit, would I still be happy if it got out of my control and was still serving the public good, right? So it's something that's kind of out of your control. People form nonprofits because they want to do some type of public good. Okay. Some pros and cons. You get that tax exemption, so you don't have to pay profits. The nice part is you can accept donations, and it's not an income where you're going to get taxed on it at the end of the year. So if you get that $100,000 donation, you don't have to pay that money to taxes. The PTA, I believe, is something different than a nonprofit. So from my understanding, Jumi, that PTAs are a different governing body than a foundation. So, but I'm talking from memory, which was a while ago. Let's see. There is public scrutiny with a foundation. So if the government is granting you tax-free organization, you're still using the roads and the fire and the police and everything, but you're not paying into those services you get. So basically, the government and everyone else is giving you free money in the form of not paying taxes. So there is public scrutiny to see if you're actually doing a public good. So, all right. Let's talk about one other form of organization. It's called a public benefit corporation. And what is it? It's a new form of corporation where as part of the company's charter, or the, what organizes and defines how you're going to run your business, a public benefit corporation is a legally binding commitment to do public good. So you're basically stating legally that your company will do some type of good. It's not available to start in all states, but it is a for-profit company with a legally bound requirement to do some type of public good. If you're not familiar with Kickstarter, Kickstarter is a company that you can launch products and get people to crowd purchase your products, crowdfund your products. Kickstarter became a benefit corporation, and I'll send the link here, a couple of years ago. they actually were a regular corporation, and they reincorporated in 2015 to become a benefit corporation. Basically, it's a public statement that says their mission is to help bring creative projects to life. And they're listing here in their charter, parts of their charter on the public website, what they're going to be doing. Like, they will not lobby or campaign for public policies unless they align with their mission values. They'll support creative and equitable world. Will donate 5% of the after-tax profit towards art and music education. So it's a legally bound thing that they're going to be doing it. They're still paying taxes at the end of the year. They can still draw profits from the company and pay their owners. They can still sell it. They can do all these things. But they're making a pledge to do these public goods. So if you want all the benefits of having a for-profit company, but you still want to do good, this is another option for you to set up your business that way. You won't be able to get the tax-free benefits. You won't be able to get donations tax-free, but it does create an environment in your company that makes you more than just any other company. So it's good for your employees. It is good for your customers. It is like Kickstarter is like crowdsourcing, but the for-benefit corporation is, you don't have to be a crowdsourcing business to be a for-profit business. For-benefit corporation. Nonprofit orgs, do they get audited, and by what organization? I don't know who. I know the IRS would be looking at a nonprofit business and figuring out if they're above it, but there's got to be some groups that audit business. I don't know if that's part of the charter for a nonprofit to get audited, but I know that they do have to abide by the IRS's rules. So. Okay. Let's move on to LLC, and I think that's the last one. So hang on, I know there's a lot of information tonight, so you're doing great. Of course, I can't see all of you. You're probably all sleeping in your onesies, hanging out. I muted you all, so I don't hear any snoring right now. So you're like, it's taped, I'll just fall asleep. Right? Okay, LLC. You'll notice on the drawing that I put like a little shield, and this was the same icon as the sole proprietor. So the LLC is technically, it's not a corporation. Some people think that LLC stands for Limited Liability Corporation. It actually stands for Limited Liability Company. So it's technically not a corporation, but it gives you the protection like it is. Okay. It's a hybrid model between corporation and sole proprietorship. It provides more liability protection. You don't have shareholders, you have members. And members can be individuals, other LLCs, corporations, or foreign entities. So it doesn't have to be just, people that own the LLC. You're taxed similar to a sole proprietor because it's passed through. One thing to note is that federal government doesn't recognize LLCs. So it's state by state how they're set up. So that's why you get that K-1 or tax form of how much profit you made at the end of the year. And you send that form on to your IRS when you're doing your taxes at the end of the year. So that's why it's passed through, and it's organized state by state. I believe most corporations in California, I think all three of them are $800 a year to form and maintain. So an LLC, C Corp, S Corp, and nonprofit, I believe they're all $800 a year. I know for certain that LLCs are, because I have one. So the last time I checked, they were all $800 a year. So they're a little bit, yeah, it's the same, good. So it's a little expensive to start up. Plus, if you get an attorney or an accountant to help you set it up, there's that expense. So it's not cheap, and they're not cheap to maintain. So again, cheap is relative. And it can also go up if you have more revenues in your business. If you're a $10 million business, you're going to pay more than $800. So it's based on how much you make. It's in my notes in Blackboard. It's got all the links to that. But I believe if you're under 250,000 a year, it's in sales, then it's $800 a year. I believe that's what it is. So I could be wrong. And the steps to create are similar to a corporation. You choose your business name for the LLC. You file articles of organization. And this is the statement that you send to the state that says who owns the LLC, who the members are. The operating agreement stresses how you run the business, who owns it, how you distribute profits, right? And then you obtain your licenses and permits. So I want to talk about this operating agreement real quick. So let's say that in this, oops. Let's change this again. So let's say that you have this business, 500,000 bucks that you made a year. Expenses were 400,000. Your profit at the end of the year was 100,000. But let's say that you're thinking about getting out of this lawn care business and you want to do some architecture. So you've set up a system where you hire one of your other workers and they buy into your business, right? So now you've got a partner and it's 50-50. Okay. So your operating agreement will say certain things. So if you make $100,000, right, and you're off doing architecture and this new business partner that's 50-50, she's doing all the work, do you split it 50-50? If it's 50-50? What if you want to keep some of the money in, right? What if you get this K1 at the end of the year and you have the 30,000 bucks because you're doing you're doing your architecture work and you're like, I don't want to take any money. I want to grow the business. I can pay this 30,000 bucks. But she is like, no, this is all I do. I can't afford that. I need to draw some money out. How do you draw money out? So the operating agreements say how you draw things out, how much you leave in. What if she decides to, wants to get a brand new work truck and wants to get a loan, and she comes back the next day and she's got a new work truck and she's got a new $50,000 loan from the bank? Does she have the right to do that? Does she have to ask you first? So these are all parts of the operating agreement. It says how you distribute money, how you take loans. What happens if she marries this guy that you can't stand, right? And this guy is a total jerk. You don't like him at all. And God forbid she dies, right? Are you suddenly in business with her husband? Right? Or does that become an ex-husband? So in that situation, what happens if one of the co-owners dies? Does it transfer to that person? Are you suddenly in business with somebody else? These are all, the what if statements that an operating agreement should write out. And if you don't have it written out, man, it gets real confusing real quick. What happens if you go 50-50 with, not 50-50, if you go 50-50 with somebody and then they decide they want to leave and don't do any more work, do they still get all the profits even though they're not doing any more work? So how would you buy them out? What happens if they want to sell it? So all these things are, like I said before, when you're forming the company, if you don't have any experience setting up a business before, hiring that attorney sounds like a really good idea, because they can help you outline the things that are common in business. So you're not paying an attorney thousands of bucks for their work sometimes, because you're like, why are you spending $300 for an hour for an attorney? You're really paying them for their expertise and setting this up right, and they're saving that money down the road. So in that case, I heartily suggest, if you're setting up a business with a partnership, with partners, I should say, that you look into filing and getting an attorney to help you go through that process of setting up the operating agreement. Okay, I don't mean to scare you, but it's good to think about this stuff ahead of time. How are we doing? Overload? You guys are good? Go, go, go. All right, I'm going. Got a little bit more to go tonight. Okay, so I have an activity for you, and here's the link, and I want you to check out this website. And if you don't know what Kickstarter is it's a platform that if you have an idea for a product or service, you can upload it to Kickstarter and make a little video, and people can check out what you got. So it's for a new product, and people can pledge money and they can pre-buy your product or service. So whether, if I say a service, like if you're doing a movie and you don't have the funds to actually do the movie, people can pre-buy the movie. If you have a product, then people can pre-buy your product, and then you get it made. So it's kind of a way to raise money with high reward and low risk. I've launched one business or one product on here. So I've done it myself through our product called Alpha Bandits. We launched it on Alpha Bandits, and I think I'm on here somewhere. Hello. There I am. So there's me and my partner. We're discussing this game that we made, and we had 186 people pre-buy the game. So we raised about $10,000 to make the game. So it's a great way to just test the market and see if people are interested in your product before you even want to do it. Okay. There's other games. What's the Exploding Kitten game? There's a game called Exploding Kittens. It's a card game. It's a deck of cards, and it raised $8.7 million. They had the same goal as me. I wanted to raise 10,000, so did they. Yeah, they raised $8.7 million. They had some pretty cool art. So they just had an idea that really resonated with people. They also had a real famous artist doing the stuff. So exactly what happened. Maybe I'll make another game. No, I learned a lot of lessons from that. Yeah, there's a lot of amazing products on Kickstarter. So I want to give you an example of one, and then I want to give you something to think about. Let me pull this up. So you've probably seen this before, and you know the backstory of it. This is a project called The Coolest Cooler, and you can watch the video if you want. I'll give you a few minutes to do that. But you don't need to see the video. The video, basically the idea that he's created is a cooler that's way cooler than your regular ice chest cooler, because it's got a battery in there with a blender, so you can make margaritas. You've got a speaker in there, you've got a USB charger, you've got a light inside the cooler, you've got gear tie downs, you've got cutting board and paper, not paper, you've got plates and stuff like that. You've got a bottle opener in it. So they raised, what did they raise? $13 million. This was a prototype, and they created $13 million, and they had about 60,000 people that pre-bought that game, or the ice chest. Okay, so the ice chest cost about a little under $200, and they had 60,000 people that thought that coolest cooler was the coolest thing. Jimmy asks, how do you raise the money? Is it by selling or what? You basically pitch your idea, and then you get the money, and then you get that money in your account. Kickstarter keeps like a little percent, like 5%. Yeah. Well, like 3% goes to credit card fees and stuff like that, and then 2 or 3% goes to them to maintain Kickstarter. So of that 13 million, they got to keep like close to 13 million of it, right? Huh? Yeah. And then they have to make the product and they have to ship it out to everybody. So, 9 times out of 10, if you buy a product through Kickstarter, you're going to get it. But every once in a while, the makers don't do what they say they're going to do.
Wait, and then you can sue them or whatever.
That's been a debate. Like, that's been a debate whether you can sue. That's why they say pledge instead of pay. So.
Oh, that's smart.
Yeah. I mean, part of it is like anything. If you scroll down to the bottom, each one should have risks.
We might not send.
Yeah, each one says risks. It's like no one wants to see a good idea go bad. So these are the risks. In manufacturing, we might screw up. We might adjust the product. We might not be able to fulfill it. So they acknowledge the risks in the Kickstarter, but they also talk about why they would overcome those risks. So just like a good business plan, you acknowledge the risk in case something happens. That way, if you end up failing, you go back to that and you say, like, see, I told you there were lots of risks. Anyway, so I don't have more content on here, but I want you to, there is a thing that I want you to look at and we can talk about in about 15 minutes. Where is it? Coolest cooler. There it is. So look at the Kickstarter, take a few minutes to do that. And then there's also, here's a case study, and I wrote this case study out. So this is not what happened in real life. It's just something I mocked up. So here's the case study. And it goes to a background, and it basically says that this guy who created it, Ryan, started this business as a sole proprietor, raised 13 million bucks, created the 60,000 units, shipped them out, and now he's got Target coming to him, the retailer Target, saying, hey, I want to buy 50,000 of them, and I want to sell them in my Target stores. So he's trying to figure out, that 13 million bucks is great, but he had to spend all that money shipping it and whatever. So he doesn't have enough money to basically do the inventory and distribution for 50,000 new ones. So he's asked his best friend, Sarah, to help out. She's good at distribution, getting products into big retail stores, right? He's asked his friend, Steve, who's a potential investor, that says that he can bring like 3 to 5 million bucks of investment in there. But he's figured out that he needs about $10 million to raise. Okay. So what I want you to do is read through this case study, and then look at these 3 questions. And as a class, we'll figure out these 3 questions. What type of organization should Ryan form? Should he be a sole proprietor, partnership, LLC? What's the advantages and disadvantages of doing that? Other advice Ryan should hear before he continues his discussions. And I'm going to add another question in here. How should he partner with Sarah and Steve? So we're going to be the consultants, and we're going to give Ryan some feedback. Okay. So let's come back in at 8:30. That's about 10 minutes. And I'm going to pause the recording for a little bit, but I'll still be here.